As we reflect on the third quarter of 2024, several key themes have shaped the investment landscape over the past 3 months. First, a global easing of financial conditions. Second, a broadening of market participation. And third, some mixed economic signals. Now, we'll explore these topics in depth shortly, but first, let's review market performance. Despite bouts of volatility, the third quarter concluded with healthy returns across most major asset classes. Early August saw stocks hit hard, driven by weaker US economic data, a rate hike from the Bank of Japan, and thin summer liquidity. However, the long-anticipated rate cut from the US Federal Reserve finally materialized on September 18th. Fed Chair Jay Powell didn't disappoint, delivering a 0.5% reduction in the overnight rate. This, along with a less hawkish tone from Japanese policymakers and renewed stimulus from China's central bank, eased investors' concerns, sparking a market rally into the latter half of the quarter. Matco's investment platform also delivered healthy results in the third quarter, contributing to robust year-to-date returns. Now, starting with Matco's Opportunities Fund, which is up 28.7% year-to-date. Matco's Global Equity Fund is up 14.3%. Matco's Balanced Fund up 9.3% year-to-date, and Matco's Canadian Equity Income Fund up 8.7%. Last but certainly not least, our Diversified Income Fund up 4.4%. Globally, while economic data remains relatively healthy, central banks have taken note of some softening trends in labor markets, manufacturing activity, and consumer confidence. Inflation is also moderating to more reasonable levels. These factors have prompted central banks to initiate broader financial easing. Sweden, Switzerland, Canada, the Eurozone, the UK, New Zealand, and the US have now all cut rates, with more expected. Meanwhile, China's economy has struggled, and in response, the People's Bank of China introduced significant stimulus measures. This stimulus package included issuing 2 trillion yuan in special sovereign bonds, cutting banks' reserve requirements, and implementing fiscal measures in the form of consumer subsidies. Now, these actions, although late in the year, aim to support China's 5% GDP growth target. Now, bringing it back to our home soil here in Canada, the Bank of Canada has also lowered rates 3 times, bringing our overnight rate from a peak of 5% down to 4.25. Global financial condition easing is clearly underway. In contrast to the tech sector's leadership in the first half of the year, its momentum stalled in Q3. Investors shifted their focus towards companies poised to benefit from easing financial conditions, with global real estate, global value sectors, global small caps, and emerging markets being the clear beneficiaries. The global tech sector's underperformance shows through in the global growth sector, lagging with the 3.5% performance in the third quarter. Although the tech sector slumped in Q3, the broader market participation is a very welcome development. Within North America, similarly, it was the real estate, utilities, financial, and material sectors with the most consistent performance leadership. No surprise, as these fall into that value and interest rate sensitive areas of the market, which are now participating in both the market broadening as well as the theme of interest rates moving lower. Earlier in the year, we highlighted economic resilience as a key theme. While resilience has persisted, particularly in corporate profits, Canadian and US earnings are on track for 6% and 10% growth respectively, there are, however, signs of weakening beneath the surface. Slowing labor markets and softer consumer activity have prompted central banks to shift their focus from controlling inflation to avoiding deeper economic slowdowns. In Canada, the unemployment rate has risen from 4.8% in July of 2022 to 6.6% currently, with a 0.2% increase in the third quarter. The US unemployment rate has edged up from 3.4% in January of 23 to its current level of 4.2. Now, overall, the picture being painted is a dichotomy of economic signals. Company fundamentals remain strong while broader economic metrics are decelerating. Whether the broader economic metrics can restabilize will hinge on a few factors and risks. First, will global central bank rate cuts sufficiently buoy regional labor markets and consumer activity? Second, will geopolitical turmoil in the Middle East intensify to a level that disrupts global economic activity? And lastly, will the US election uncertainty stall business leaders in executing their corporate growth strategies? Now, these uncertainties reinforce the importance of maintaining a well-constructed investment portfolio. A soft economic landing would support continued growth and higher equity prices. With stock markets reaching new all-time highs, much of this optimism is, however, priced in. Conversely, a worsening of one or more of the risks mentioned could derail current growth trends. In this context, maintaining exposure to diversified income assets can help provide downside protection and allow for smoother returns. While analysts remain optimistic, as asset managers, we understand that complacency is not a good strategy. Our focus is to manage our investment platform and client portfolios through all market cycles. This does require balancing growth opportunities with adequate downside protection. We remain committed to our risk management, cycle analysis, Matco's M-Factor process to build those resilient portfolios. Markets and economies are always evolving, but our process remains constant.